This is another great setup for the 35 bounce strategy. You can see it's met all of our rules and it's also met our most recent conditions. So now when we right click on the charts, we get an option to trade. We can either buy, sell, or create new order. So when we click on create new order, you can see we get this order box here. So we can buy or sell the market. We can do a market order, we can do a limit order or a stop order. But doing it this way, we don't have our take profit and stop loss filled out, and we have to manually calculate out our units. It's not ideal. The easier way of doing it is to right click on the trade we have set up and go create limit order. We have all of this info filled in immediately. Our take profit and stop loss is marked by these points here, and we put in our risk, let's say 2%. We see 2% of 500 is $10, so it's calculated out the exact amount of units it will need to buy for this trade, and we can actually move over to market order and we still have the option of our 2% risk. And we can see our reward to risk ratio changes as we go between limit and market order. Now that is expected because if we enter a market order, it's going to enter the market no matter where it is right now. So if I am to place this limit order, we can see it's saying it's got a sell limit of here, and it looks like the price is beyond there. It is sitting in the red, but the order has not been taken. That's due to our spread. We actually have to wait for the price to move further into the red before it'll trigger our limit. Now, if I go to place another trade, I'll say create limit order, and this time I'm going to move across to market. I'll once again put in 2% risk, and we can see here our reward to risk ratio has changed from 1.25 to 1.03. So although this looks like it's sitting in the same area, our spread is 15.2. So the offset of our spread means we'll enter the trade somewhere down here. Let's have a look. Well, there we are. We've placed our trade. We are now entered. I had to sell the market down here, and it's here saying we're at minus $2.40. So that is the spread actively coming into play. This shows a visual between the difference between a limit order, where we want it specifically at that price, and at a market order, where we entered the price based on where the candle and the spread was at the time. Because we've risked 2% of our account, and we've got actually a different value, we have a much larger stop loss here in comparison to where this trade would be, we've actually had to buy fewer units to make up that 2%. It's just reverse calculating out that 2%, and we can see it's moving up a little bit. It'll be interesting to see if it actually hits the sell limit order as well. If we had set up this trade and we hadn't come back to the markets for until tomorrow morning, let's say, there may be a few candles that push up here, and that would give us a much greater reward to risk ratio. Now, if we were to place a stop order while price action was up here, it would wait for the price to actually come back down and hit our initial price point. This is particularly handy for if we are unsure of this move here and we think actually this may be where the market reverses. It's kind of a safety measure of keeping us out of that trade until we are sure that it's actually going to hit the price we want and continue.